Hi, welcome to Market in a Minute. So, our message last week was to take profits. It's still our message. As we look like we're going back to Iran, we know the playbook. We're going to have a little bit of a knee jerk reaction to it in the overall markets. So, take some profits here and there, and then be ready to play the rotation theme. If oil prices drop, inflation expectations are going to drop, interest rates are going to drop. That's going to fuel a lot of the other stuff in the market that's kind of lost its momentum here. Good fundamentals in like the consumer area, but these stocks have just stalled out and are trending lower at this point, creating some really good values. So what's happening is the momentum in the market, it's in the tech space, in a concentrated area in the semiconductors. It's driving really bad decisions right now on what people are buying. Disclosures, please read that at your convenience. So on the market update, we're going back to Iran, okay? We think these guys in Iran are just completely idiotic. I mean, why are they doing this? Maybe that's the only way they survive, but they're going to get wiped out. Frankly, it's the best thing that could happen in the long term. A little bit more pain for the stock market than probably what we anticipated, but we think we're going to see, a little bit of a decline in the overall markets, and then a big rotation into the areas of the markets that look really attractive. And I'll go through that in some detail, but the consumer space looks really attractive at this point, but it needs to get through this. The result is the market's playing these AI stocks. So the market thinks these are low risk stocks. They're not. Semiconductors are not low risk. They're very high risk, particularly the memory stocks that have been running. These are the worst quality stocks you can imagine to own. So what goes up in these chip stocks are going to come back down at some point in time, especially the memory stocks. There's going to be some good companies out of all this, but it's not the memory stocks. So the market's not looking at the terminal value. It's looking at momentum at this point. So it's being really short-sighted. Trump's trip to China should turn out to be very positive. I think there'll be some good announcements coming from that. So we think that's going to be a positive coming out from the trip in China. Earnings have been spectacular, okay? And it's, again, largely driven off the semiconductor space. But look at these advances. Big moves in the short term. This is 2027, 382 now. And then on the this year, 2026, 334. Remember, this was like about 305 not very long ago. So we've had big moves in the earnings expectations. So what's happening is that the earnings for next year being much higher, it's bringing the PE ratio down to about 19 times. That's pretty interesting, 19 times earnings. However, it's in the memory stocks has really been driving the earnings up. So there's no way you're going to pay much of a multiple for those earnings. That's the problem with it all. But in general, we think that our 7850 on the S&P 500 is very doable. Granted, it was a much more attractive target, say 2 or 3 months ago. Now there's only 6% upside left in it, in our opinion. So it's being much more competitive. Long bonds are being much more competitive. Now, 10-year Treasury, for example, yielding 4.3 or 4.4% on a risk-adjusted basis. Now it's pretty much equal to what you're going to get out of the stock market. So just keep that in mind that on a risk-adjusted basis, stocks aren't looking as attractive, and the prudent investor should be taking some profits here, which we are. We're cashing in on some of these profits. So the market dynamics. There's a few things I want to cover with you. Being a mutual fund manager for years, I know what it's like to be under pressure to outperform the market. I've never really followed that pressure, but that the pressure is there by money managers to make sure that they aren't falling behind the S&P in any significant degree, and it's becoming harder and harder. Right now, the market is thinking that core inflation is running about 3 to 3.5%. We're going to get inflation numbers. Again, the market's very short-sighted, so it may start to say, okay, the core inflation is 3 to 3.5. It's not. It's really more like 2 to 2.5. So we see as oil prices come back down, that expectation is going to flip back to being 2 to 2.5%, which you have plenty of room to cut rates and stimulate the economy. The market is solely focused on massive spending in AI, and it can't rotate to the other areas of the market because Iran is still out there. So it's stuck on AI, can't rotate to the consumer or the financials or healthcare because it's concerned about the price of energy prices. Now that's going to come back down. So the semiconductor stocks, some of them anyway, are in a bubble. So sell those bubble stocks or protect yourself in some manner. We're thinking about how to profit off the next big decline that's coming in the semiconductor space. Maybe it's not a near-term event, but we're thinking about the semiconductors coming back down in a big way at some point, perhaps when we get this big rotation coming in the overall markets. So I think sometimes being a money manager, having experience is more of a negative than a positive when you're in these type of markets. As a money manager, what's important is to realize that you're in this momentum-based market. You got to participate in it to some degree, but don't drink the Kool-Aid. I saw so many people just get completely wiped out after the tech bubble in the late 1990s. So they were just completely they drank the Kool-Aid. They thought the dot-com phase was here and it's changing everything in the world. Granted, AI is important, but don't get so fixed on what's happening in the short term to realize what's going to happen in the longer term or intermediate term. There's going to be good companies like Google and Amazon. They're going to continue to be great, but these companies that are just riding this cycle, they're going to come right back down at some point in time. So just keep that in mind. Right now, let's try to make as much money as we possibly can, but let's be prudent about it. So here's what's going on with money managers. So if you're at a big mutual fund or you're running a big pension or whatever, and your mandate is to outperform the S&P 500, okay? With 50% of the stocks in the S&P 500 in technology, that's a hard task. No prudent investor would put 50% of a diversified portfolio into technology. So that's what the money managers are grappling with. How do they keep pace with this? I can understand having 20 or 25% in tech. That's even a stretch in my opinion. But having 50%, that's just an impossible task for somebody that looks at the risk side as much as they do as the reward side. So if you're money manager being paid to outperform, you're forcing money into things that you don't want them to be, don't want to go into. So that money being forced in there is also driving the retail money that doesn't know any better, that doesn't really do any sort of valuation work. They just see the stock going up, are going to follow it. So that money manager is kind of stuck into plowing into things that they don't really want to go into. Just keep in mind, the best way to outperform is when the cycle starts to unwind is to protect your capital. So you don't want to go down 30 or 40%. So going down that amount is really hard to make back up. So just keep that in mind. We are in a bubble in some areas of the market, not all areas. Most of the areas look actually pretty reasonable, but some areas we're in that bubble phase, and it's unwise to take any significant risk in those particular stocks at this point, particularly in the tech space, even though that feels good at this point. Now, we can be smart about it and buy tech stocks selectively, and that's what we're doing. And we're trying to keep pace with what's going on in the overall markets. Now, tactical moves, okay? This is what we're doing. So obviously the big question is, how does the market react to the war starting up again? well, it's going to have a negative reaction, but then it's going to have a positive reaction. So we think that in general, the market will continue to look through it. It's not going to fall 9% like it did earlier in the year from high to low. Maybe there's a couple percent decline, and then you get this big rotation occurring. Then you're going to see some of the tech stocks weaken up, in our opinion. So as the Iran war becomes completely over, there's lots of upside in consumer stocks, but other areas as well. We like the financials and we like healthcare, particularly the small cap healthcare stocks. They look great. Amgen, large cap, that one looks good too. But a lot of consumer stocks are going to do really, really well once we start to get this decline in energy prices. We talked about Qualcomm before, and frankly, we didn't make it a big position. We had it in one or two of our strategies, and it's set up well. I mean, down here where we bought it, that broke that 20-day, 50-day, 100-day, 200-day. Now it's almost 50% above the 200-day moving average. The fundamentals really haven't changed much. They announced that they were going to have an AI chip, which we knew about. Everybody following the stock knew about it, but for some reason it woke the stock up well before it's even on the market. So we don't even know what that AI chip looks like, but we think that the momentum in their business is coming back next year, but more so in 2028. So this stock's a sell. We're out of it. Wendy's, okay, you talk about a dog. This has been a real dog. Sorry, my grade school friend, Wendy Thomas, back in Columbus. This stock was as high as $24 per share. Okay, now it's down below 7. We think it's turning. On a technical basis, there's a lot of room for this thing to go. And, it's got a long way to go. Maybe there's some overhead to it, obviously, but anybody that's owned it is out of it, really. Nelson Peltz owns 16%. Nelson Peltz is an activist investor. And I think he's going to do his darndest to get this get his money back, right? Make the money back that he's probably lost in it, but to get this stock moving again. So the stock has a 8% dividend yield, and they're doing a big promotion. We think that this promotion program is going to turn those comp store sales around nicely in the second half of this year. And then they announced a big development agreement in China for 1,000 new stores. Now the company's got some unit growth back to it as well. So big promotion, margin's probably going to get better, comp stores are going to get better domestically, big international growth, nice dividend, activist investor owns it. I don't see any reason why, somebody wouldn't want to own this stock. May want to wait till they see the actual fundamentals turn, but I think it's too cheap. Another restaurant stock, PZZA, Papa John's, we think that's going to be bought out by private equity. The closed-end funds, okay, of private technology, they've been ripping higher. Okay, so the well above their NAVs. I mean, just multiples above their NAVs. DXYZ, VCX, RVI, all up big. They're all anticipating SpaceX. Remember, some of these don't even have SpaceX in it, so RVI is moving for other reasons. But these stocks are something to focus on. There's another one coming, and we'll let you know as soon as we know the timing of it. But there's another one coming, and we are going to buy as much as we can if it opens at a reasonable level on their self-listing. So SpaceX is in the OTF. This is the Blue Owl Technology Fund. They sold half. I think that's a big mistake. We think SpaceX, when it comes public, is not going to have a big float, and it's going to be driven higher as the tech investors. It's going to be driven higher as the tech investors and retail try to get a hold of this. So we think that SpaceX is going to probably do pretty well right out of the gates, and maybe push the Nasdaq higher as well. Celebras, CE Celebras, CRBS. So this is a chip company. It kind of looks better than what NVIDIA is, believe it or not. So lack of information, because it's we don't have a whole lot of information on it, but this is coming public on Thursday. We think that this might be one worth, catching some, as it's probably going to pop quite a bit, and then holding on to it. So we'll have to see. But a CRBS, we think that might be interesting as a tech play in the semiconductor space, and having something new and creative about it. Their technology may be much better than the NVIDIA technology, bringing down the amount of power needed and actually making the chips faster. So if you have any questions, please let us know. Come to my website, Patrick Adams CFA, sign up for a hard copy of Market in a Minute. Just remember, the next 2 weeks, we're not going to put Market in a Minute out. So don't think we disappeared for any reason. And, take some profits, be a little bit defensive, get ready for that rotation, and don't get caught up in that Kool-Aid part of this phase into the semiconductor stocks. Be selective. Thank you very much.